Welcome to today's explainer. You know that completely mundane, everyday water flowing right out of your faucet? Well, it turns out it's actually the foundation of a highly lucrative, totally recession-proof financial empire. You turn on your tap, and that clear liquid isn't just a life-giving necessity, it is pure, uninterrupted cash flow. Okay, let's dive into this.
While everyone else is out there losing their minds chasing volatile AI startups, crypto, and the next big tech unicorn, we're going to look at why the absolute smartest investors in the world are quietly accumulating water assets. Think about it. You can live without streaming services, but you literally can't go a few days without water. It's an undeniable necessity, which honestly makes it a fascinating business model.
So, here is our roadmap for the explainer today. 1. The ultimate local monopoly. 2. A recession-proof revenue machine. 3. The rate-based capital game. 4. The ethical water dilemma. And 5. The investment playbook.
Let's start with Section 1, the ultimate local monopoly. Why competition is impossible.
Just imagine if your town had competing water companies, kind of like competing pizza places. Company A lays pipes down Main Street. Then, Company B wants to compete, so they dig up the exact same street to lay parallel pipes. Economically, that is completely absurd. Water utilities are what we call natural monopolies, protected by this massive, basically insurmountable underground moat. We're talking $50 to $500 million just to build a municipal system, plus decades of permits and sheer physical limitations. You simply cannot disrupt a water utility with an app.
And the ultimate result of that massive moat? Well, it's a microscopic customer churn rate of just 0.01%. People might pack up and move houses, sure, but the house itself, it stays connected. While tech startups burn through mountains of cash just to acquire a single user, water utility customers are literally locked into the system for life.
Moving right along to Section 2, a recession-proof revenue machine, fixed and usage charges. This revenue machine thrives on a really solid mix of residential and commercial usage. Now, residential makes up about 60 to 70%, but the commercial and industrial clients, they are the heavy hitters. They use anywhere from 3 to 5 times more water per account, and the best part for the utility is, during hard economic times, a manufacturing plant cannot simply conserve its way out of needing water. The whole thing is incredibly recession-resistant.
But wait, it gets better. Because do you think the utility only makes money delivering clean water to your house? Nope. It turns out they actually make money on both ends of the pipe.
By taking the dirty water out, utilities add a massive 40 to 60% to their overall revenue. And the real kicker here is that wastewater volumes are incredibly easy to predict and often yield even higher profit margins than just delivering the fresh water in the first place.
Beyond those basic monthly bills you and I pay, utilities tap into these hidden gold mines. We're talking municipalities paying up to $5,000 annually just for fire hydrant access. New housing developments pay massive impact fees just to connect to the system. There are late fees, government contracts, and, get this, sludge and biosolids sales. Yes, these companies are literally treating wastewater byproducts and selling them right back as fertilizer. It is a brilliant, multifaceted revenue stream.
Which brings us to Section 3, the rate-based capital game, where the real money is made.
Now, pay really close attention to this next concept, because this is where the absolute magic happens for these companies. The rate base is the total value of a utility's infrastructure assets. Regulators actually allow a guaranteed return on this rate base, typically right around 8 to 12%. This means that if a utility builds $100 million in infrastructure, regulators effectively guarantee them an $8 to $12 million annual profit.
This creates a truly fascinating financial incentive. Check this out. When infrastructure ages out or the EPA tightens its standards, the utility invests capital to upgrade its pipes or treatment plants. Then they file what's called a rate case with regulators. Because they technically improved the system, regulators approve the price hikes. Build more, earn more. Basically, every single necessary pipe replacement legally raises prices on consumers.
Let's shift gears a bit for Section 4, the ethical water dilemma, controversies and challenges.
Now, the water business isn't exactly morally simple. It's a real balancing act. Activists rightly point out a very real ethical dilemma. Commodifying a basic human necessity for profit can literally force low-income families to choose between paying for water or paying for groceries. But on the flip side, proponents of the system argue that public water systems are frequently mismanaged and dangerously underfunded.
From their view, private companies bring desperately needed capital, efficiency, and expertise to keep our drinking water safe and reliable.
Similarly, there are some pretty serious concerns about monopoly abuse. Critics understandably fear that private monopolies will just exploit their captive customers and price gouge them since, there's absolutely zero competition to keep prices honest. However, the reality of how the system works is that every single rate increase is governed by public utilities commissions. This is a highly transparent, adversarial review process that often takes 12 to 18 months to complete, meaning a company cannot just randomly decide to spike your bill overnight.
All right, let's look at Section 5, the investment playbook, why the smart money is buying. There are 4 massive macro tailwinds driving this entire sector right now. We've got climate change causing water scarcity, which obviously makes existing infrastructure even more valuable. We've got population growth and much tighter EPA regulatory standards. But perhaps most importantly, the U.S. faces a severe aging infrastructure crisis, requiring over $1 trillion in upgrades over the next 2 decades. Remember our rate-based concept? Every single dollar spent on those much-needed upgrades directly expands the highly profitable guaranteed rate base.
When you compare water to other asset classes, the appeal just becomes crystal clear. Unlike the wild volatility and crash potential of tech stocks or the broader S&P 500, water utilities offer an unbeatable combination: a super steady 8 to 10% annual return with very low volatility and supreme recession resistance. Even when the stock market is in total panic mode, water usage stays completely, boringly stable. So, you might be wondering, how does one actually get exposure to this? Well, retail investors have multiple paths. Unless you just happen to have $10 million lying around for direct ownership, you can look at publicly traded giants like American Waterworks or Essential Utilities. There are also diversified ETFs like PHO and FIW for more passive investors, as well as tax-advantaged municipal bonds offering 3 to 5% yields for conservative portfolios.
And this actually brings us to a fantastic quote from Warren Buffett, whose company, Berkshire Hathaway, happens to own massive water utility positions. He famously said, "Invest in businesses any idiot can run, because sooner or later one will." Water utilities fit this absolutely perfectly. They are highly predictable, heavily protected by regulations, essential to human life, and basically entirely idiot-proof.
So here's the crucial takeaway. Investing in water is definitely not about becoming an overnight tech billionaire. You're not going to end up on the cover of a startup magazine for buying water stocks. But it is a get-rich-sure, long-term wealth-building strategy. It's exactly the kind of investment that lets you sleep soundly at night while the broader markets are crashing, simply because your product is a literal necessity.
So I want to leave you with this final, somewhat provocative thought to ponder today. Knowing the immense, mathematically guaranteed profits wrapped up in this industry, combined with the deep, undeniable ethical tensions of commodifying a human right, would you add water to your portfolio? Or do you believe this essential resource belongs strictly to the public? Thanks for joining me on this explainer, and keep questioning the economics hiding in plain sight.